Hello everyone, welcome to Slow and Steady. This video is for all the budding students who are aspiring to become CA one day. So your CA foundational exams around the corner is in December 2022. So you have hardly 2 more weeks to revise all the portions or the resources which you have studied so hard for all these long days and to complete the leftover portions. So these 2 weeks are very crucial for your preparation to secure good marks in the CPT exams. So here is a small initiative from our side. It is a small effort. We are going to revise the mock test paper to make your revision simpler and quicker. So here in this video we will be revising mock test paper for paper 4. So in paper 4 you have business economics and BCK, that is business commercial knowledge. So from business economics you will be getting 60 questions and from BCK you will be getting 40 questions. This video we are going to quickly revise 30 questions from business economics for mock test paper March 2022. It is going to be quicker and simpler from the exam point of view. We are going to approach the questions from the exam point of view and remember all those small things. So it will be quicker and simpler for you. So please watch till the end and make your revision well good to be prepared for the exam day. So without any delay, moving to the first question. Here the first question is, which of the following are the characteristics of business economics? So business economics has three main characteristics. That is, it is a normative science, it is interdisciplinary because it incorporates both microeconomics and macroeconomic thoughts into the business environment, and it is pragmatic in nature. So the answer is all of the above for the first question. The next question, which branch of economic theory deals with allocation of resources? So from the business economics point of view, allocation of resources comes under internal or operational issues of the firm. So this thing is dealt under microeconomics. So microeconomics basically deals with the internal or operational issues of the firm, under which what are all the other things it handles is like demand analysis, cost analysis, profit analysis, production analysis. So in the production analysis, allocation of resources comes under and play a major role. And apart from this, market structure, pricing and everything, the microeconomics deals with the every operational issues in the firm. So the answer is microeconomics for the second question. Moving to the next one, under which system freedom of choice is an advantage? So the answer for the question is very straightforward. It is capitalism, because socialism is also called as command economy. Mixed economy is the combination. It has both the features of socialism and capitalism. So there also presents some extent of command. But capitalism is free from command. So by command what I mean is government intervention. There is no government intervention under capitalism. Under capitalism, the main priority is given for private properties. Private properties were given main priority under capitalism. So in capitalism, you can enjoy freedom of choice. The next question, taxation involves which aspect of normative economics? So what is normative economics? Normative economics is basically opinionative economics. Opinionative in the sense that when you give some suggestion or the things which need to be done, that is called normative economics. For example, if I say taxation in the economy should be fair for all. This is an opinionative statement. It is my opinion that the taxation in an economy should be fair to all. So here Fairness deals with the normative economic side of taxation. The next question. Suppose we are drawing a supply curve of a farmer. Which of the following will be held constant? So when I draw the supply curve for a farmer, the price of the commodity under consideration should be held constant. So the answer is D. Next one. A fall in the price of commodity where everything else is held constant is referred to as. Uh, Before solving the question, the first thing you need to remember is when there is change in the price changes, there will be movement along the demand curve. That is, this is the demand curve. So there will be upward or either downward movement along the demand curve. So this we refer to as increase or decrease in quantity demanded. When there is changes in other things apart from price, okay, not price here. What happens? Demand curve shifts. There is no movement, it shifts. Okay, so the demand curve shifts either upward or downward. Here we call it as increase or decrease in demand. Not quantity demand, it is simply demand. When price changes, there is increase or decrease in quantity demand. When there is changes in other things apart from price, we call it as increase or decrease in demand. So here what happens? A fall in the price of commodity. So the price is changing. You all know when price increases, demand decreases, and price decreases, demand increases. So there is inverse relationship between price and demand. So here the price is decreasing. Fall in the price of a commodity where everything else is held constant. So when price decreases, what happens? Demand increases. Where as I said, when there is movement along the demand curve, we call it as increase or decrease in quantity demanded. So here price decreases, so demand increases. So increase in quantity demanded. Therefore the answer is A. Moving to the next question. For Giffen good, the Engel curve is, how the normal Engel curve will be? It is positively sloped because it is the relationship between income and demand. Engel curve represents relationship between income and demand. So usually Engel curve will be positively sloped, but it is not in the case of Giffen good. So what is meant by Giffen good? Giffen good are the inferior good. Okay, so Giffen good are the inferior good for which when price rises, demand also rises. Giffen good is a special kind of good where there exists positive relationship between price and demand. So here what happens is income effect is more. Therefore, what will be the shape of the Engel curve? Negatively sloping. When income rises, demand decreases. The relationship is in the reverse direction. When price increases, demand increases, and when income increases, demand decreases. This is the relationship between price, demand and income for Giffen good. Therefore the Engel curve will be negatively sloped. What in the case of demand curve? The normal demand curve which we draw between price and demand. Here the demand curve will be positively sloped for Giffen good. The next question. A theory. So what does it mean by theory? Theory is nothing but a validated hypothesis. Hypothesis is some questions with some questions which need to be answered, that is called hypothesis, or need to be proved. When I make a statement, that statement can be either proved or made it to a wrong side. This statement isn't right or this statement is wrong, that is called hypothesis. So what is theory? Theory is validated hypothesis. Either we say I have validated the hypothesis to be right or wrong. So here the theory is validated hypothesis. And the next question, the coefficient of price elasticity of demand between 2 points on a demand curve is. So how we measure price elasticity of demand? We have three different things. One is percentage method, under which we calculate, how we calculate percentage method, percentage change in quantity demanded divided by percentage change in price. Sorry, this is percentage change in quantity demanded. This is divided by percentage change in price. The next method is point elasticity, point method. And how it is calculated? If this is the demand curve, any point on the demand curve, if we measure the elasticity on any point of the demand curve, that is what it is called as point method. Then it is called as point method. The next thing is arc elasticity. So how we measure arc elasticity? Arc elasticity is measured between 2 points, when there is 2 points on the demand curve is taken, and how the so I have taken these 2 points. When I measure the elasticity between these 2 points, it is called as arc elasticity. The question is coefficient of price elasticity of demand between 2 points. So between 2 points, we need to measure the elasticity. So that is done under the arc elasticity method. So the answer is arc elasticity. The next question. When the demand curve is a rectangular hyperbola, an increase in the price of the commodity causes the total expenditure of the consumers of the commodity to do. So what happens is, when I say demand curve is rectangular hyperbola, the elasticity is equal to 1. The elasticity of this demand curve is equal to 1. Therefore, what happens when the price of the commodity increases? The demand will be when the price of the commodity increases by 1 unit, the demand for that commodity will be decreased by 1 unit. So therefore there will not be any changes in the consumer expenditure. So the answer is remains unchanged. What happens to the consumer total expenditure? It remains unchanged because there is equal reduction in the quantity demanded by the consumer for the equal amount of rise in the price. Therefore, the expenditure remains unchanged. The next one. A movement along a curve rather than a shift in the curve can be measured by. Okay. This is upward shift in the demand curve. It causes by the other things which we have kept constant. The movement is caused by price. So what we need is the movement along the curve rather than a shift in the curve can be measured by. How can we measure that? The only factor responsible for the movement in the demand curve is price. So the price elasticity of demand, here the thing is given as curve. It is not given as demand or supply. So the answer will be the price elasticity of demand and the price elasticity of supply. Why not income elasticity and cross elasticity? Because income is a factor reasonable for the shift in the demand curve, and cross elasticity is similarly. Cross elasticity is dealt with substitute and complementary goods. So those are all the price of those goods are also reason for the shift in the demand. So only factor that is responsible for the movement along the curve is price. Therefore, C is the correct option. The next question. The most important function of an entrepreneur. So what is the most important function here? The answer is innovation, because entrepreneur has inbuilt sense of responsibility and he has to finance the firm. Everything has to be done. But when the entrepreneur fails to make some innovation, some kind of innovation, in the long run the business will not prevail. So that is why the answer for this question is innovation. The next question, how do the TVC curve behaves when the law of diminishing returns begins to operate? What happens? So this is quantity, this is the cost. Okay, so how the TVC curve will be, this is how the TVC, total variable cost curve, will be. So when the law of diminishing returns begins to operate here, at this point, when the total variable constant reaches the phase of constant, and the law of law of diminishing returns begins to operate. So after this point, what happens to TVC? Rise at increasing rate. So this is the option, which is D. Rise at increasing rate is the answer for the question. The next one. In the short run level of output, the firm at the optimum will be. So what the question asks is, in the short run, the level of output, the firm at the optimum will be. So how the firm in the optimum will behave in the short run, that is what the question asks about. So it can either maximize profit or minimize the total loss, because only in the long run the loss can be completely get ridden off and maximum profit can be achieved. But in the short run, most of the firms try to minimize the loss or to maximize the profit. Anything can be done. So the answer for this question is C, 14C. Moving on to the next question, which is 15. Both factor price and quantity moves in the same direction, then it is called. When both, that is price increases by 1 unit, output also increases by 1 unit. So what this represents is that nothing but constant cost industry. When both the price and output increases at the same rate or in the same direction, it is called constant cost industry. The next question, if the monopolist incur losses in the short run, then in the long run. Okay, the question is about monopoly, not the perfect competition or monopolistic. In the monopoly, anything can be done in the long run, irrespective of their stand in the short run. Long run, anything can be achieved by the monopolist. So the answer for this question is any of the above is possible, because it will stay in the business. Monopoly can either stay or leave out the business, or even they can achieve the break even point or achieve maximum profit. Anything of these things can be possible for a monopolist in a long run. And always not in the long run, not in the short run. So the answer for this question is any of the above is possible. The next question, a cartel which is market sharing will reach the monopoly situation. So what is cartel? Cartel is the agreement between few or more oligopoly firms. So some of or many of the oligopoly firms comes and forms a cartel in which they agree upon a particular price or particular level of output that can be produced or particular share of market. So these are some of the agreements that oligopoly firms comes and together and make. So what I mean, when the question is asking about when it will reach the monopoly situation. Anytime, I mean, sometimes or not, maybe they can reach or they cannot reach, because there can be any disputes among the existing firms, so the cartel can be dissolved, or they can I mean, they can, everyone can come together and agree upon a proposed common objective or anything. So sometimes they can achieve or sometimes they cannot achieve. So the answer for the question here is the sometime. It is not always when the production is homogeneous or product is differentiation. It is not the case for these two things, and the thing is not none of this, because sometimes they can achieve the monopoly situation. So the answer here is sometime. Moving on to the next question. Here the substitution effect will be stronger when. So what is substitution effect? Substitution effect creates when there is rise in the price. If the consumer goes for the alternate or substitute goods, then it is called a substitution effect in a simpler terms. So when there are like closer substitute, when goods has closer substitute, sorry, sorry, okay, when goods have closer substitute. So for example, I have been consuming good A. When the price of the good A increases, what will happen when I have a closer, sorry, when I have a closer substitute B, the price of good A is keep on increasing. What I will do, I will switch to B. So here the substitution effect will be stronger. There is lower cost of switching to the substitute. Okay, if there is, that will be switching cost. I mean, when I ignore this product and go on, I mean go to use the product B, when the cost of switching is low, then also I will move to good B. Then there is lower inconvenience while switching to the substitute codes when I didn't feel. For example, when there is no for a person who likes coffee, switching from coffee to tea has lot of inconvenience for them. So in that case, the substitution the substitution effect will be lower. But when it is between switching between 7-Up and Sprite, there is no inconvenience. Those two are like closer substitutes, so you can easily switch between those two things. So what happens here? Lower inconvenience while switching to the substitute codes. So in that case also the substitution effect will be stronger. So here the answer for the question is all of these, because all these things are possible for the greater substitution effect for a good. The next question. Increasing returns to scale applies to. There are two different things. One is law of variable proportion. Sorry. The next one is law of returns to scale. There are two different laws that deals with the relationship between the input and output. In law of variable proportion, what happens is, you all know, production is equal to function of output and labor. So in this law of variable proportion, what we do is we keep either one of the factor inputs, that is either capital or labor, to be constant. For example, in the law of variable proportion, if I kept capital as constant, the labor is the only factor that varies. So that can be that deals with the short run aspects, because in short run you cannot have both capital and labor to be a variable input. Either one of the input should be fixed and the other input should be varied in order to maximize the output or reduce the cost, anything. So this law of variable proportion deals with the short run because of its nature, as we need to keep one of the input variable to be constant. Here in law of returns to scale, both the capital and labor are variables. There is no necessary for a factor input to be kept constant in the law of returns to scale. So under law of returns to scale, there are three types of different returns to scale. One is increasing returns, the next one is decreasing returns, the other one is constant returns. The question is for increasing returns to scale. As I said, law of returns to scale is applicable for the long run because it has all the all the input factors to be variables. Therefore, the answer is long run. The next question, isocount. So what is isocount? This is the isocounts. Is input A and input B. These are the isocounts. So isocounts are always otherwise called as equal product curves. Iso product curves. Iso means nothing but equal. So it is also called as equal product curves, and the thing is production indifference curves. So you all know the basics of indifference curves, so how the indifference curve is for utility. The same way, the same theory and the logic which we applied to the production side. So it is also called as production indifference curves. So therefore the answer for the question is all of the above. So far we have completed 20 questions. The 10 more questions are to be completed. So we are quickly going to do that. Stay with me in the process, okay? Who describes production function as the relationship between maximum amount of output can be produced and the input required to make that output? So this definition for production function is given by Samuelson. So according to Samuelson, the maximum amount of output can be produced and the input required to make the output, that relationship, that function is called production function according to Samuelson. The next question. The concept of marginal cost is closely related with this. So what is marginal cost? It is the addition made to the existing total cost. The same concept is also applied to economic cost. Economic cost is accounting cost plus some implicit cost. This implicit cost is the same concept which we deal with the marginal cost. So the answer for this question is economic cost. Now, when the average product of labor is maximized, the marginal product of the labor. So let us draw the diagram. This is the average. Okay, sorry, I'll draw it once again, quicker and simpler. Okay, this is the average product curve. This is the marginal product curve. So you can clearly see here how the marginal product and the average product behaves when average marginal product is increasing. Average product is also increasing. When marginal product begins to fall, average product begins to increase at the decreasing rate and eventually achieve the maximum point where MP is equal to AP. So when the average product of labor, average product of labor APL is maximized here in this point, the marginal product of labor will also be equal to the average product of the labor APL. Moving to the next question. Time element in market was conceived by? The answer is Alfred Marshall, because he brought in the time element to the market and classified market based on time into 4 different types. So what are all the things? Very short period, long period, or very long period. So these are all the 4 different types of periods which Alfred Marshall divided the market. Very short period market, long period market, and very long period market. So the totally 4 different types he classified based on the time. The next question. Cross elasticity of demand for the monopolist product or any other product is? What is cross elasticity? Cross elasticity for monopolist. For who is a monopoly? Monopoly, in a simpler term, is a firm without any close substitutes. For their product, monopoly is a firm that operates single-handedly in the firm or the market. It is the only firm in the market that produces or supplies a particular type of product where there is no close substitutes for that product. So what the cross elasticity deals with? Cross elasticity deals with the substitute products, goods, price, and the price of the good. So how the cross elasticity for the monopolist will be? It will be either 0 or very small, very negligible. So the answer for this question is 0 or very small. It can be very small, like very negligible. It need not be exactly perfectly equal to 0, but some cases it will also be 0. So the answer for, and it can never be high. So this answer is either A or B. It can either be 0 or very small. Next, moving to the next question. In a monopolistically competitive market, what are all, this is the question. What are all the options? It says firm face a perfectly elastic demand for its product, does not face a perfectly elastic demand for its product, cannot be determined, none of these. So basically the question asks whether the monopolistically, not the monopolist, it is monopolistically competitive firm. Okay, how the before moving into how the perfect elasticity demand curve will be, it will be horizontal. And this demand curve is for what? You all can remember this demand curve is for perfectly competitive market. Perfectly competitive market has perfect horizontal demand curve, which is otherwise called as perfectly elastic demand curve. And how the demand curve for the monopoly firm will be? It will be steeper. Sorry, it will be more steeper. Because the demand curve for a monopoly is inelastic. Monopolistic firm is neither monopoly or a competitive firm. Monopolistically competitive firm has the features of both monopoly and competitive. It is a market in between the two extremes. So how the monopolistic competitive firm's demand curve will be? It will be slightly flatter, but it will not be so steeper as monopoly firm, and it will not be so perfectly horizontal as perfect competitive firm. It will be slightly flatter but still steeper. So therefore monopolistically competitive firm can never have a perfectly elastic demand curve. So the answer for this question is does not face a perfectly elastic demand for its product. Because if the demand curve should be perfectly elastic, then it should be of horizontal line, and that line is for perfectly competitive market, not for the monopolistic competitive market. Then moving to the next question. Price discrimination to be profitable, elasticity of demand in the different sub-market will be. So who will be using price discrimination? Monopoly firm. Monopoly firm uses price discrimination to maximize their profit. So what is mean by price discrimination? Charging different prices for different sub-markets. Different prices. So when a firm, that is monopoly firm, to access maximum profit, how the elasticity of the different submarkets should be? It should be different. If it is same, mostly competitive, monopoly firm charges the price based upon the elasticity, and you all know the monopoly firm has an inelastic demand curve. So when the level of inelasticity is different in different submarkets, then only monopoly firm can successfully incorporate price discrimination and achieve maximum profit. Therefore the answer for this question is different. The elasticity should be different across different markets for a monopolistic firm to imply the price discrimination. The next question, only 3 more questions. The 28th question. What is the 28th question? Supply schedule in a purely competitive firm in the short run is determined by. Okay. So this is quantity, this is cost and the price. You all know this is the average cost curve and this is the marginal cost curve for a perfectly competitive firm. So in the short run, the supply schedule for the perfectly competitive firm is this positive slope. You can clearly see up to here the marginal cost is decreasing. After a certain point it is started to rise. This portion of the marginal cost is the supply curve for the perfectly competitive firm in the short run. So the answer for this question is marginal cost curve. You understand why we have taken this marginal, this positive slope of marginal cost to be the supply schedule of the purely competitive firm. Now moving on to the next question. The turning point of business cycle. So the turning point for business cycle is predicted by all these 3 factors. lagging indicator, leading indicator, and coincident. So the answer for this question is all of the above. The next one, fluctuation in economic activities are due to. When I say fluctuation in economic activities, so what is the economic activity? It is demand, supply, price, inflation, employment, and everything. These are all the economic activities in an economy. The question does not ask for a particular individual consumer or a firm or anything. It talks about the economy. When the things are generalized, it always talks about the economy. So when there will be fluctuation in economic activities in a particular economy? When there is change in the or the fluctuation in aggregate demand. When change in money supply will also cause fluctuation, profitability of the firm, everything will affect. But the main thing, the direct influence is from fluctuation of aggregate demand. So therefore the answer for this question is fluctuation of aggregate demand. So all, now we have completed all the 30 questions. You have you have learned to attempt it from the exam point of view, how the question needs to be particularly cracked or something. The things you need to remember is, always read the question fully and imply the logical thinking behind the question, and then try to answer it. Don't always attempt the questions on the direct perspective. Have some logical background to support your answer, then it will be easier. So this video, I think it is helpful for you to quickly revise the first 30 questions of the paper 4 mock test paper. I will try to bring the next 30 set of questions as soon as possible for me. And thank you. Do subscribe and like and click the bell icon to get more notification. Thank you.